Welcome to Coadep Econs Academy. Today we want to move a bit further in our study of national income accounting. We want to look at the steps through which we can arrive at national income from GDP. Before we start, let's familiarize ourselves with the following abbreviations. NI will be used for national income, GDP for gross domestic product, NDP for net domestic product, JNP for gross national product, NNP for net national product, FC for factor cost, MP for market price, SD for statistical discrepancy, SA for stock appreciation. Let's remember that in our earlier lesson, we started with a closed economy with our government. And because of that, we dealt with an economy consisting of only households and firms. In that economy, we saw that the monetary value of goods and services that were produced in the economy constituted national income. But today we are moving to a more realistic economy. In this economy, we are going to have households, firms, government. We also have foreigners. That means that we are engaging in international trade. So we can have foreigners moving into our country with their factors of production to engage in production activities within the borders of our country. That means that we also have the external sector or abroad, and we will have some of our nationals abroad. So there will be some of our citizens also moving their factors abroad to work there. Now, what we should keep in mind is that foreign nationals, when they bring their factors of production into the country to produce, at the end of the day, the income that they earn, we consider that income as factor income paid abroad, because this is income that are accrued to foreign factors, so they can repatriate that income home. In the same way, we have our nationals abroad, and the factors of production they send also earn income, which they bring home. So we call it factor income received from abroad. So in this extended economy, where we have foreigners coming in and some of our nationals going abroad to work, we have these extra terms we should keep in mind. Foreigners bring their factors to earn income, and they take it home, so we call it factor income paid abroad. Our nationals go out with their factors to work and earn income. They bring it home, so we call that factor income received from abroad. Now, we have an important term, GDP. When we talk about GDP, we are only concentrating on economic activities that go on within the borders of our country. So domestic means that within the borders of our country. So when we take up within a particular period all the goods and services that have been produced within the borders of our country, and here it is regardless of who produces it, whether it is produced by citizens or foreigners, it does not matter. All that matters is that the goods and services were produced within the borders of our country. When we take the monetary value of all these goods and services that were produced within the borders of our country, we term it as GDP, gross domestic product. We can see that in this case, what we produce within the borders of our country, which we term as GDP, cannot satisfy the definition of national income, because we are having foreigners here in the GDP. Also, the GDP does not cover all our citizens' activities because some are abroad. So there are a lot of adjustments we have to make if we have GDP before we can move to national income. Before we move on, let's also understand that in actual production, our capital depreciates. There's wear and tear of capital in the course of production. So at the end of the day, we should account for depreciation before we can actually talk about what we have actually added. So when we want to know the actual income we have generated, we have to make allowance for the capital that we have destroyed in the process so that we can replace them. In any calculation of national income, we take out depreciation. And when we do that to GDP, we arrive at NDP, which is net domestic product. So when we talk about net domestic product, it is our gross domestic product less depreciation. Now, back to business. When we talk about national income, we are only interested in the income generated by our nationals, our citizens, and it is regardless of whether they are within the home country or they are abroad. So when we are talking about national income, then we should be able to look out for this term first, what we call gross national product. Gross national product means that we are talking about the value of all goods and services that have been produced by our nationals within the period under consideration, regardless of whether they are in the home country or they are abroad. So how can we get this figure? It is simple. We can obtain this figure from GDP. Now, when we take GDP, we can first of all add FIA, which is factor income from abroad. After that, we have to subtract from GDP the income owned by foreigners, and that is factor income paid abroad. So when we subtract that, then we arrive at JNP. So when we talk about JNP, it is taking GDP, adding factor income from abroad, and subtracting factor income paid abroad. At the end of the day, this will give us the monetary value of all goods and services produced by factors owned by nationals of a country, regardless of where they reside in the world. As I said earlier, we cannot say that we have generated income without replacing the fixed capital that we have destroyed in the process. So let's make allowance for that. So when we take our JNP and we subtract our depreciation, we get our NNP, which is net national product. Now, if we are using the income approach, then our values will be in what we term as the factor cost. Factor cost means that we are getting values based on the actual cost of production. So from the producer side, the actual value of production is what we term as the factor cost. That means we don't have any indirect tax or subsidy in this form of calculation. If we are fortunate to be using the income approach, for instance, then our net national product will be at the factor cost. Whenever we have net national product at factor cost, it means that we have arrived at our national income. However, when we are using the expenditure approach, we are picking values from the market. So when we arrive at net national product, it will be at market price. Market price means that there are additional components which are indirect tax and subsidy. So we need to move a step further to remove these indirect tax and subsidies so as to be able to get our values at factor cost. Now, that is the essence of the presence of government. Government will impose indirect tax or grant subsidy. When they impose indirect tax, it makes the price higher than it actually is. When the government grants subsidy, it makes the price lower than it actually is. So then what should we do? Whenever we have NNP at market price, first we need to subtract indirect tax because it makes the price appear higher than it is. After that, we also need to add subsidy because when the government grants subsidy, it makes the price lower than it actually is. When we are able to do this, we move NNP from market price to factor cost. Now, we also want to consider another source of divergence. We should expect that GDP, which is gross domestic product, should be equal to GDI, which is gross domestic income. But most often, we don't have the two to be equal in practice because we usually use different sources of data to calculate GDP and GDI. And because of that, we do not get them to be equal in practice. The difference between GDP and GDI is what we term as the statistical discrepancy. And because of this, whenever we use the income approach, we expect that we should add statistical discrepancy to net factor income at factor cost. We should add the statistical discrepancy. If it's positive, we add it. If it is negative, we subtract it to arrive at our national income. Still on income approach, we may ask ourselves, what are some of the sources of the statistical discrepancy we talked of? One clear example can come from holding gains. So the stocks we have, when we produce, usually there is a lag between the period of production and the period of sales. Therefore, we keep stocks. Now, because of inflation, the price of the stocks can increase, and this will increase the profit of the firm. But it doesn't mean that actual production has increased. Therefore, whenever we hold on the stocks and we have a gain, then it is our duty to subtract that gain. Also, deflation may decrease your profit, and you have to add it to get the actual income that was generated. This gain is what we term as stock appreciation. We have to subtract the stock appreciation to get the actual income, and in the case where we have loss, we must add the amount of loss so as to get the actual income. So these are the steps we need to go through when we have GDP and we want to move it to national income. Thank you. I urge you to subscribe, like, and share to promote the channel.